All right, so we're only an hour, so I'll start it. Yep. You ready? All right, if you guys will allow me to interrupt. We only have an hour for today, so I'm going to try to get us started reasonably close to on time. As we move ahead with this, well, I'll explain the procedure later on, but I'm going to try to, as I said, I'm going to try to keep us moving a little bit. All right. Well, good afternoon, everyone, and thanks for joining us. This is the latest installment in our continuing conference series, Tax Reform, Perspectives from Across the Nation. Jointly sponsored by tax analysts and the American Bar Foundation, we've had sessions in Chicago and New York and Gainesville and Atlanta, today in San Diego. We have more planned for Boston and Los Angeles, and then a few in Europe, actually, later on in the fall. I'm Joe Thorndike. I'm a contributing editor at Tax Analysts, and I'm going to be today's moderator. By way of background, Tax Analysts is the nonprofit publisher of tax notes, state tax notes international, all sorts of good tax things. Since our founding more than 40 years ago, and it's actually probably closer to 50 at this point, we have been trying to defend the public interest in a policy arena that I say is shot full of private interest. Of private influence even. And this is our 15th year of sponsoring public conversations and public events around tax practice and policy. The session is also co-sponsored by the American Bar Foundation, whose executive director, Ajay Mehrotra, moderates a lot of these panels and could not be here today. But in Ajay's stead, let me tell you that the ABF is an independent nonprofit research organization based in Chicago. They've been around since 1952, doing empirical and interdisciplinary research on law, legal institutions, and legal processes, including research on tax compliance and public finance. The ABF has partnered with tax analysts to help enrich our national discourse on tax policy and practice. And speaking for tax analysts, let me just say that we are very fortunate and very grateful to have the ABF as our partner in this. Today's discussion is going to focus on the prospects for fundamental tax reform, or what Speaker Ryan just this morning and often likes to call historic tax reform. What makes this effort historic in the Speaker's mind, at least I'm assuming, is its distance from 1986, the last time that Congress really took anything, did anything that might be construed as fundamental tax reform. If it happens this year, it will be historic in the sense that it's a rare event and unusual, or maybe even important. But since I'm an historian by training and only a tax person by actual practice, I'd like to offer three historical rather than historic observations about this opportunity. Number one, partisan unity is not all it's cracked up to be. I think often when people say, oh, this is a historic opportunity for tax reform, what they really mean is that, hey, for the first time in a while, we have the same party controlling all the levers of government. So that seems like a great opportunity to use the old chestnut for the stars to align for something really dramatic like tax reform. It's worth remembering, though, that the last time we had historic tax reform, it was under divided government. And Ronald Reagan and Dan Rostenkowski in particular and Tip O'Neill made common cause to push tax reform through. And I think, ironically, it may sometimes be easier to push through a bipartisan, compromise-laden bill than it is one that in which the people are arguing with one another and within a party are arguing with one another. And I think what we've seen recently in the last year or so is, and Tax Notes has covered this extensively, as has the mainstream press, is an awful lot of bickering within the Republican Party about what constitutes desirable tax reform. So I think what it tells us is that there are limits to the value of partisan unity. When the President's plan, when we first started this conference series, it was in the spring, and the President had just released his famous statement, his one-page statement on taxation, tax reform, which was noted for its brevity, but also for its inconsistent fonts, but also for its general consistency with his campaign promises on tax reform. It joined a debate that to that point was more or less dominated by the House Ways and Means Committee blueprint for tax reform. I think it's called the Better Way for Tax Reform. The Senate, meanwhile, had been working on a corporate integration proposal for, I think, years, and still is. When the administration released its plan, the Treasury Secretary, Mnuchin, said to reporters that the White House and congressional Republicans were 100% in sync. And on Capitol Hill, the GOP leaders were almost as enthusiastic when they said that they were 80% in agreement with the remaining 20% in the ballpark. When I first heard these comments, I thought, hey, well, that's pretty good. 20%, that's not a whole lot. And then I spent a day at the Smithsonian Museum of Natural History with my daughters, and they reminded us there that human beings and domesticated cattle have an 80% overlap in their DNA. And I thought, well, all right, that last 20% can be a little bit tricky. And the last 20% has proven to be very tricky. One of the major proposals made by the House was for a border adjustment tax to replace the corporate income tax, and that proved to be predictably very controversial and ultimately fell by the wayside. Tomorrow we're expecting another statement of tax reform principles, this time from the so-called Big Six, a working group of congressional and administration figures. And lately, and I think we'll be talking about this at some length today, some details have leaked about what the Big Six is going to say. Those may be mostly trial balloons or partially trial balloons that get deflated, but in any case it seems that President Trump is going to give a speech tomorrow in Indianapolis that will establish some benchmarks for what they're after. Our panelists may have more inside information to pass along, but generally, just to give it some specifics, what seems to be coming out of this, at least from what I've heard most recently, is that the Big Six will support a corporate tax rate at or around 20%, a top individual rate of 35% in some sort of scaled-back three-bracket system, a new rate for pass-through income in the vicinity of 25%, some sort of apparently temporary full expensing designed to, we'll talk about what it's designed to do, but the temporary part to keep the costs under control. Doubling or near doubling of the standard deduction. Omitted from most press reports, oddly, but probably important, is a repeal of the estate tax. I think it's just taken as such a given that people don't even mention it anymore. And a repeal of the deduction for state and local taxes to help pay the bills for all of this. Also notable, the Senate seems to have come to a budget agreement to make room for tax reform, which is important. It's sort of a battle between those Republicans who think tax reform is important at any price, and maybe especially if it has a big price because we need a tax cut, and Republicans, again, this is all a debate on one side of the aisle, who are concerned about growing deficits. They've agreed on what appears to be a $1.5 trillion limit for the tax cuts, which is probably not quite enough to get all of their wish lists enacted, but is a big step down the road. I want to make three observations, which I'll try to do quickly so that the people who actually know what they're talking about can occupy you. But I want to make three observations about, or two more observations actually, about this sort of historic moment. The first is that the tax system is uncertain and certain to stay that way. In recent years, we've heard a lot of complaints about tax uncertainty. They've been loud and frequent, especially from the business community. I think that's partly driven by a sense that the level of dysfunction, particularly around the corporate tax, is so extreme that it's unsustainable. Something has to change. Depending on who you're listening to, we have 2 trillion, 3 trillion, 5 trillion. You get all sorts of numbers for profits that are still overseas, and there's a strong desire to somehow repatriate those profits. In any case, that creates a sense that something must change. I personally can understand why taxpayers want certainty and why they find the current environment uncertain, but a taxpayer's hope for certainty is really more like a farmer's wish for perfect weather. It's understandable, but not very likely. Supreme Court Justice Oliver Wendell Holmes once observed that certainty is an illusion and repose is not the nature of man, and that laws in particular, such matters really are a battleground where the means do not exist for the determinations that shall be good for all time, and where the decision can do no more than embody the preference of a given body in a given time and place. We don't realize how large a part of the law is open to reconsideration upon a slight change in the habit of the public mind. Those reconsiderations have been frequent around tax. Since 1960, we've enacted about 70 major tax laws. It's more than one a year and a pretty good clip. And that understates the case. If we include numerous laws that modify taxes in more incidental fashion, we have nearly 400 pieces of tax-related legislation since 1979. Certainty is unlikely to be a payoff in this sort of an environment. In a democracy, constant is a change. what I tell people about tax reform is that you should never think of it as a destination. It's a process. It's an event. It's sort of like cleaning out your closet at home, right? You clean out your closet because you need to do it. You aren't under the illusion that you're never going to have to do it again. I mean, you're going to have to do it soon, maybe the next year. And so that's certainly history supports that about tax reform. So I don't think that certainty is really likely to come from any of this. The last point I want to make is that public opinion is a problem here. In general, Americans like the idea of tax reform, but they like other things even more. They aren't especially optimistic about the prospects for making reform happen, and they're notably skeptical about the likelihood that it will benefit them personally. In a recent poll in August, 12% called tax reform the nation's top priority, and by comparison, 31% said health care, 21% jobs, and 14% terrorism. Of the 7 options, tax reform placed 5th. More troubling, Americans don't seem part of the consensus supporting business tax cuts. In May, and I put consensus in quotes there, in May, a Quinnipiac poll found that 39% thought reducing the corporate rate to 15% was a good idea, but 55% did not, and it gets worse. In a Gallup poll, 67% said that corporations were actually paying too little, and in a Pew Research Center, they found 62% were bothered a lot by the sense that corporations were not paying their fair share. There is some support for cutting taxes, especially when it supports especially around small business. And actually, there is polling data on the new pass-through rate, and it actually is fairly supportive, which I think says something about the way Americans feel about small business as an abstract concept. But historically speaking, Americans have traditionally been very enthusiastic about taxing corporations and not very enthusiastic about cutting corporate taxes. So I think that poses a problem for a tax reform legislation that is really built around the business side of things. All right, I'm done with my observations here. I want to make a couple of points. We are recording this event for viewing later on our website and elsewhere, and that explains, well, I suppose cameras are a usual thing here. But for media purposes, if there are any media here, we are on the record. Also, that means that when you stand up to ask questions, and I hope very much you will all ask lots of questions, please tell us who you are and what organization you're with. I want to thank the University of San Diego Law School for hosting this event, and also our panelists, who I will now introduce. First, we have Victor Fleischer, and I'm going to read Vic's bio almost verbatim when he gave me, because you'll see why at the end. Professor of Law at the University of San Diego, where he teaches partnership in tax, corporate tax, and tax policy. Before moving to San Diego in 2013, he spent time teaching at Columbia, UCLA, Colorado, Illinois, Georgetown, and NYU. An infamous 2006 draft of his NYU Law Review article, 2 and 20, Taxing Partnership Profits in Private Equity Funds, is often credited with sparking the debate about how to tax carried interest, and I think that is exactly right. He also wrote a column for the New York Times for several years called Standard Deduction. To escape the vicious and bitterly partisan atmosphere of faculty politics, Vic says, he headed for Capitol Hill in 2016, where he worked for the Senate Finance Committee as Democratic Chief Tax Counsel. Also, we have with us Cathy Koch, the America's Tax Policy Leader for EY. Before joining EY, she served as Chief Policy Advisor to Senate Majority Leader Harry Reid, advising him on tax and economic issues. Her Hill experience also includes stints at the Senate Finance Committee and the Joint Committee on Taxation. Her private sector experience also includes 2 years as a Director of U.S. Tax Policy for General Electric and another 2 at Amgen. All right, with all that long introduction, I will now pass this off to our panelists here, who are going to make some comments, and then we'll just have a conversation, which will hopefully involve all of you as well.
So thank you, Joe, and thanks to Tax Analysts and the American Bar Foundation for putting together this series of events on tax reform. So a couple of words about the state of play before moving forward. So I want to talk a little bit about the Big Six. These are the 6 folks who have been charged with mapping out a plan, and those folks are Gary Cohn, who's the director of the National Economic Council in the White House, Steve Mnuchin, the Treasury Secretary, Paul Ryan, the House Majority Leader, the Speaker of the House, Kevin Brady, the Chair of the Ways and Means Committee, Orrin Hatch, who is the Chair of the Finance Committee, and Mitch McConnell, who is the Senate Majority Leader. So you'll notice all of those folks are Republicans. So I feel a little bit bad that we don't have a Republican panelist to sit up here with us today. On the other hand, I still think they have the upper hand in tax reform right now. The plan for tax reform is to do it on through a reconciliation vehicle. So there's a special process in the budget rules that allow for certain types of fast-track legislation known as reconciliation. And there are various rules around that, and if you comply with those rules, you're allowed to fast-track the legislation through both chambers. There's limited debate, limited amendments, and there's some special rules about how much revenue you can increase or decrease through that vehicle. The reason that they're doing this is if they comply with all of those rules, then they only need a majority in the Senate. It's not subject to the usual filibuster in the Senate. So it's very much a partisan approach. And the extent of the bipartisanship that I think they're thinking of, I don't think of as bipartisan. They might try and peel off a couple of votes from vulnerable Democrats in states that had voted for President Trump. So that's just to give you the backdrop. Mostly what I'm doing here is responding to what the Republican plan is, and then maybe later we can talk about where I think there is some room for bipartisan work if things should go in that direction. A couple more things I think we will hear from the administration tomorrow or in the weeks to come. I agree. I think it's just going to be a slightly longer set of bullet points from what we've seen in the campaign and earlier this year. I think you will see an increase in the child tax credit. That's something that Ivanka Trump has been pushing. As Joe mentioned, corporate rate probably around 25%, special rate for pass-through entities, partnerships, and LLCs, that's and S-corps at 25%. And I think we will also see a significant change to the way that we tax U.S.-based multinational companies. I think they will announce a move to a territorial system, really a modified territorial system with some kind of a minimum tax on income that comes out of tax havens in order to try and protect the tax base. Something you don't hear as much about outside of Capitol Hill, but it occupies a lot of attention on the Hill, a lower tax rate for repatriated foreign earnings. So the companies that have stockpiled earnings offshore will be allowed to repatriate that cash back to the United States at a rate of, I would guess it's going to be 8% on cash and 4% on non-cash. I think coupled with full expensing, even if it's temporary, we will have to see some limitations, I think, on interest deductions, but people have been very careful not to talk about any specifics about that. At the end of the day, and I'm also not sure about the estate tax. I think we might see a limitation, or rather raising the exempt amount rather than complete repeal, which is a complicated issue. At the end of the day, I think what really concerns me is what's going on with the numbers. So rough estimates of what all of this will cost is about $5 trillion in lost revenue. So it's a massive tax cut. That much is true. But that's nowhere near the $1.5 trillion, which is still a big tax cut, that the budget folks have been talking about as likely to be the target number that they have to hit to meet the reconciliation instruction and get the benefit of these special rules. And so my concern, and we can talk more about this, is that what you have to do to try and get there is to either scale it back. I think we'll see some scaling back of what they're going to offer up tomorrow. You can find a lot of revenue raisers. I don't expect we're going to see a repeal of the capital gains preference or a repeal of the exemption for employer-paid health insurance premiums. Those are the sorts of revenue raisers you need to think about to raise a lot of money. I think the only one that people have talked about is repealing the state and local deduction, which means, although it'll be labeled as a tax cut for everyone, some people in this room will be some of the few, that is, people who earn a good income in California or New York, could end up being the handful of folks who are actually going to see a tax increase from the plan. And then the third so I don't think we're going to see a lot of revenue raiser. We'll see some scaling back. And then what I really worry about is I think we might see some fake math. So in the FY18 budget that Trump put out several months ago, the administration simply assumed that we would get to a 3% growth rate in GDP. So that was just an assumption, and everything then in the budget was built around that assumption. Whereas normally the way that you do economic projections is you start with background facts, and those facts then drive the results that are in your projection. Right now, the Senate budget rules would not allow this kind of gamesmanship. There are other games that you can play, and so I think we'll see a combination of budget gimmicks and I worry perhaps some fake math to try and get a $5 trillion tax cut through, but to call it a $1 trillion tax cut. So that's kind of where I see things. Cathy?
Yeah, thank you, Vic. And that was a very good layout of the rumor mill. And I tell you what, since Monday, I could sit here and read you real-time rumors as they're coming out. And a lot of them are kind of in the, they're pretty close to one another. So let me just kind of step back. My big thing with tax reform has always been, the arithmetic. I think that's even more problematic than the politics. And the arithmetic, because it's impossible to fit this square peg into this tiny little round hole, it drives the politics a lot. And as Vic was saying, we are talking about tremendously expensive tax breaks. To cut the corporate rate by 10 percentage points costs between $1.5 trillion over 10 years. So we're talking, I'm pretty bullish on a 20% rate, being the proposal out the door anyway. So, we're talking about a lot of money right there at the get-go, practically $2 trillion. So this is an expensive undertaking. The next part of the arithmetic that's really difficult to make work with all these tax cuts is the distribution. And along with, and I used to work at the Joint Committee, and I was actually tax chief at Finance the way Vic was. And we, the one thing that we always kept our eyes on is the distribution table. So it wasn't only how much things cost at the end of the day, it was who got the benefits. And that is a very politically powerful document. When it comes out, Democrats will look right away to see, did rich people get most of the benefit? Did the middle class get most of the benefit? And there will be ads run and newspaper articles. And it's really difficult to give big tax cuts and then also make sure the middle class benefits, are kind of dominate the distribution tables. It's like a Rubik's Cube. That said, I'm going to kind of go over a little bit aside from Vic and say I do expect there to be a lot of base broadening. What they're doing now is a very political kind of process, right? They're trying to sell the bill, they're trying to get support, and what they're doing is kind of, they're like talking about the sugar and not the vinegar. So, they want to build support. Now, if I was going to tell my boss how to build support, I would say, talk about the tax cuts. Talk about, the great new investment incentives. Talk about this, talk about that. Let's talk about the pay-fors later. And in a way, this strategy kind of leads it to individual members to kind of own the base broadeners or how we pay for this. And that's a little unfair. If we look back to the Camp bill, that was pretty robust process, and it was bicameral, that is the House and the Senate, and it was bipartisan. Max Baucus, my old boss, Senate Democratic chair of the Finance Committee, and Chairman Camp of the Ways and Means Committee, Republican House guy, they came up with a plan pretty much together, and that was distributionally neutral and revenue neutral. So if anybody wants to know kind of, can this be done, it was done. But I used to do these, kind of like this. And my big laugh line was, I did a word search for repeal in the summary of that bill, and there was 292 instances of the word repeal. And of course, a lot of them were double counting, but it does speak to how many things got wiped off the books, how many benefits got wiped off the books to pay for something like a 25% corporate rate and an individual rate that wasn't that reduced. And those, that's kind of where the political hurt came in. So, is this like the camp, environment, and are we going to approach this like Camp did? I don't know, but I do know that we're not going to approach it like Tax Reform 86. And I think you made a very good point about the party, all in one versus unified party versus rather shared power. The other thing that's different now than Tax Reform 86 is the driver for this tax reform is corporate reform, right? The driver for this effort is corporations who pay the highest marginal rate and a worldwide tax. And, okay, I don't like that, actually. I'm a Democrat who doesn't like either of those things. But that said, that's driving this process. In 86 tax reform, it was individuals who drove the process. Individuals vote, corporations don't. And this makes this process, it just kind of removes it from the voter one titch, and it makes it harder to sell. In addition, in tax reform 86, corporations ended up paying like $121 billion more over 5 years, and individuals paid $120 billion less. This is 86 almost on its head. So, it'll be interesting. I mean, you have to approach it in different ways. One of the big rallying cries now that corporations are finally starting to amplify, and I'm not, I'm neutral on the theory, I'll let Vic take it, but is, what is the incidence of corporate tax reductions on the worker and on the individual? How much of the corporate tax does the individual bear? And that, to me, is kind of how politically you can take individuals and get them to embrace corporate tax reduction. I mean, we know the Joint Committee thinks about a quarter of the corporate rate is borne by workers in terms of lower wages and reduced job opportunities. But, there's estimates all over the board, from really the bulk of the empirical research says between 50 and 75%, but different economies, different times are different. However, to tie these corporate tax provisions to people, to workers, I think is going to be critical to its passage because, and again, that's what drove 86 tax reform, was a benefit for people who went to the polls. I think that let's talk about reconciliation really quickly, because we did I actually did the ACA for better or for worse, and we lived through that reconciliation process, and it was hellish. And the reconciliation process has the rules that Vic was talking about are a lot. Some of them are surprisingly strict in kind of odd ways. It can't increase deficits after 10 years. Every provision has to have an explicit and purposeful impact on the budget. So, there's a lot of what we're talking about and the rumors we're hearing, I question how easily it can get through the reconciliation process. So all of these factors are going to be very interesting, and they're all going to squeeze this puppy in different directions. So the document that comes out tomorrow, I guess the bottom line is, let's look at it as the start of a negotiation between the big six and the people, right? And understand that you never put your bottom line out first. The other negotiation that's going on really is kind of probably House and Senate. The House gave up a very big provision that was very dear to them, the border adjustment tax. So now I think they kind of want some face save in this thing. There's all kinds of back channeling stuff going on, but I do think I'm pretty bullish on it happening, whether it's the best result or not the best result. I do think some tax legislation is going to be done, I'd say by March. I'd say we'd know by December we'll have something, and if we don't, it's done. But it's going to be, I think this process is going to take a lot of twists and turns, and I do think Democrats have a chance to make a positive impact on this. I just remember how powerful the Republican that we wanted to vote for our health care bill, how powerful they became. I always say Olympia Snowe, who was the one vote we ever got from a Republican, is probably still getting her car washed every weekend. So, there's a couple people floating out there. There's the three that didn't sign a big letter. They're in these red states, Heidi Heitkamp, Joe Donnelly, Joe Manchin. But there's others who are very centrist who have wanted tax reform like this for a long time. And you can kind of get what you want if you're the holdout. You're like the spoiled kid, and your mom just wants you to shut up, right? So you're going to get what you need. If they decide to come to the table, I guess I'm predicting reconciliation in the end, a 50-vote process in the Senate without real bipartisanship. But I used to believe before they started health care that there was a chance for it, and I still think Democrats can make a positive impact on the bill. Health care was not something that I would have done first. And I think I've been right. Anyway, that's all I got.
People say that about Obama and healthcare, too. Shouldn't have done it first. All right. I just want to, I'll start out with one question first, and then I want to see if the audience has some. You both talk about the math as being essentially unrealistic or at least constraining. Can't we free ourselves from that? Now, there are procedural difficulties in freeing ourselves from that. But a couple of questions. People ask me this all the time, and I don't really have an answer. One, we're so wedded, if you're a Republican, you're so wedded to the idea of using reconciliation to do this for that 50-vote majority. Why does the legislative filibuster survive in this context? They can change the rules and pass these things at 51 votes if they want to. And then why does the Byrd rule specifically survive? It's such a constraint on what the Republicans have on their agenda right now. It requires a legal change, but it's hard to imagine they wouldn't get it.
But the Byrd rule, I don't know if anybody understands, the beginning of reconciliation was a process designed to help pass tax increases to reduce the deficit. It was all developed to be deficit reducing. And because tax increases are hard to pass, they said, okay, we'll give you a pass, right, a 50-vote pass, if you're going to not do all these things that increase deficits outside. So it was designed for that. But 3 of the past 5 presidents, I said Bush, and Clinton, did tax cuts under reconciliation in their first term in office, or their first year of their term in office. So we've taken something that was well-intended and twisted a little. But that said, I'll defend the rules of the Senate. The Senate supermajority and the filibuster is designed to protect the rules of the minority. It's designed to slow down the process to make sure that the minority isn't wiped out by the majority. It's a very kind of sacred place and a sacred rule. And, nominations, blah, blah, blah. But I don't think anybody wants to see that go really. That's my personal opinion.
Yeah, I would just add the Republicans in the Senate are loyal to the Senate, and they don't want to see the culture of the Senate change into the culture of the House, which is more, it's more driven by leadership, and it's each individual member of the House is not as important as each individual member of the Senate, in part because of the filibuster and the difficulty of getting to 60, and it hasn't been that long since Democrats had the Senate, so the Republicans in the Senate remember that it works both ways. So I would be surprised. I think there is some risk that on the one hand we have all these complicated rules around reconciliation. On the other hand, the chairman of the Budget Committee Senate Budget Committee has a lot of power to change those rules. And so I do worry a little bit about what could be done. And in particular, it's the gap between sort of the rhetoric that's been coming out about how tax cuts affect the economy and the reality of it. So there's kind of this myth that dynamic scoring is just an on-off switch and that it's off now, and that if we turned it on, you would magically see huge amounts of growth reflected in the numbers. The fact is it's already on. The Joint Committee already does dynamic scoring estimates It's true under Senate rules, they're still used just for informational purposes, and that could change. But if that changes, you're not going to see, a $3 trillion difference in the score. You're going to see 300 or 400 billion difference in the score. And we could have hours of debate about the inside of the JCT models and whether they're accurate estimates of the macro effect on the economy. But everybody agrees that tax policy changes behavior, and everybody agrees that tax policy changes the macro economy, and we just debate the details about what kind of impact it's going to have. But there aren't any economists out there, Republican or Democrat, who will say that it's going to have the kind of impact that the Secretary of the Treasury is suggesting. And you can look at the right-leaning Tax Foundation. Their economists have estimates, and they're not estimating that tax cuts will pay for themselves or anything close to it.
Yeah, think about the size of the economy. It's $19 trillion, and corporate tax receipts are only $300 to $400 billion a year over the next 10 years. So, you can't. It's like it's steering the Titanic with a rowboat, or not quite, but it's certainly not the biggest lever that we have. You can't produce massive changes in the GDP with just a big corporate tax reduction.
Just last week, we had one of these panel discussions in Atlanta, and Lee Shepard, who's a columnist for Tax Notes, was on the panel, and her take on much of this was $1.5 trillion is irrelevant. It's irrelevant if you're worried about deficits. It's irrelevant if you're hoping for growth. It's irrelevant. It's $1.5 trillion over 10 years. It's not, talk about a small lever. You're trying to move an economy with $150 billion in cuts in a year. It's trivial. And so she thinks, whatever, $3 trillion tax cuts are completely plausible. She doesn't believe in any macroeconomic threats that are going to flow around that, but neither does she believe that it offers much in the way of juice for the economy. And speaking of dynamic scoring, our chief economist at Tax Notes, Marty Sullivan, often says that dynamic scoring disappoints almost as often as it saves your bacon, because you find that the numbers aren't necessarily good. Sometimes they're not good at all. The behavioral changes you expect are not the ones you get, or they're even that the models say you'll get. So just blindly hoping that, dynamic scoring means that everyone will react in a way that boosts growth, it's simply not true, and the models don't even support that. So, yeah.
Yeah, and in fact, now we have full employment. When the Camp bill was scored, it had what is the dynamic score between like 0 and 700 billion? It was this big range. But there wasn't full employment then, and there is full employment now. So that means that, if we kind of give capital investment incentives and things, you have different impacts against a full employment economy than you do against a kind of underemployed economy. And a full employment economy could mean things heat up a little too much, and then the Fed will tighten things up. So, it is not a panacea, and it is unpredictable, and it is often disappointing. But everyone is on a political, the political sales job of their life right now, right? This is the goal, the one goal, right? They didn't get health care. These are number 1 and 2 goals, and so the weight is on this one, big time.
Well, now they're talking about rolling health care and tax cuts together into 2018 reconciliation legislation. All right, I'm going to stand. I'm going to stand up in the hopes that will pressure all of you guys to ask questions. Yes, can you identify yourself when you start?
Yes, Tia Lover, Miller Watson. With quantitative tightening just being announced, the sale of all mortgage-backed securities and bonds, they're being thrown into this mix at this time. How do you see that impacting the proposed tax changes? Economy,
Yeah, I cannot, I'm not a macroeconomist, I can't speak to that. And I would guess that the tax reform effort will continue, just kind of continue. I mean, I think the dynamic scoring, you might see that would be reflected in that. The Joint Committee, they're really good at what they do. They know their stuff. But just kind of on the headline developments, I don't think it'll change it.
Yeah, it's a great question. It's a really hard question. It's one that in fact, we tried to investigate a little bit how the Joint Committee takes into account anticipated policy changes in their dynamic scoring estimates. So you might view what the Fed is doing as evidence of what they might do in the future as response, and then that might then circle back into the estimate, presumably reducing the benefit somewhat. Whether the Joint Committee factors that in, I suspect they do, but I don't know that for sure. All of which is to say the Joint Committee's estimates remain somewhat of a black box to those who are outside the revenue estimating process, and so I think the political types will just march on regardless of what the Fed is doing and see where they can get.
Somebody else? Yes, right there.
My name is Alistair McLeod, and I'm the chief for myself. This is very broad strokes. I'm here because I'm trying to understand what the Republicans really want and what the Democrats really want. I cannot figure it out. My chief concern about the state of things is deepening stratification of saying what really people are after here, besides political power. What they want to do with it is what I'm trying to figure out.
Sure, that's a tough one to answer. I mean, I think the Republicans have sincerely held beliefs that cutting taxes will increase economic growth, and that will benefit everybody. I think there are lots of reasons to be skeptical about that claim. Historical evidence isn't there. Very often, even the theory isn't there. I'll offer one concrete example. This idea about full expensing, which certain economic models really like as increasing growth. So full expensing just means you buy a piece of equipment instead of for $100, instead of depreciating it over 5 years and taking a $20 deduction each year, you take your full $100 deduction immediately when you buy it. So it's kind of a short-term boost to the economy because people are going to go out and buy more equipment and buy more depreciable assets. But there's a couple of problems with that. One is things get kind of weird, and we talked about this in partnership tax, when you start thinking about buying a commercial office building with a 45-year useful life and deducting the entire amount immediately using borrowed funds. It creates massive tax shelter problems unless you have really good interest deduction limitations. So that tends to be a lawyer question, not an economist question. I'm not sure the economists have fully worked that out, and it's going to get messy in practice. Secondly, the corporate managers who make most of these decisions to purchase equipment and buy a factory and so forth don't care as much about full expensing as you would think. In fact, most of them don't want it because it would be coupled with a limitation on interest deductions. So why don't they want it? It's because corporate managers care more about reported earnings than they care about cash flow, because it's reported earnings that drive the stock price, and that's how they're compensated. So the true behavioral effect of full expensing is going to be muted. It's not going to have a giant boost to the economy. So obviously there are people out there who disagree with me, who disagree with the egghead lawyer and economist types. But I do think it's a sincerely held belief that cutting taxes will grow the economy. What do the Democrats want? I'm not sure. I think there's a variety of opinions within the Democratic Party that span all the way from the left wing of things. Who there's a campaign now that says "not one penny" is the hashtag. This is not the time for tax cuts. And then you have more moderate members, especially in the Senate, who would. I certainly think there's a lot of agreement that we should have basic reform of a lower corporate tax rate, and in order to reduce some of the distortions, and fixing the international system so that there's no longer an incentive to reinvest offshore instead of onshore. And so I've always thought, there is 80% agreement or more, and that if we had the opportunity to sit down in a bipartisan way, if the politics were different, I think my year in D.C. would have been very, very different than it was. But the politics are where they are, so I think the primary goal of each side right now is to win, and that it doesn't go too much further than that at the moment.
That's a very good answer. And what both sides should want, and Vic alludes to this, is, they need to connect with the individual voter, with the people, and they need to connect with this generation of people who lost their jobs in various recessions and were never, ever, we were never able to help them. We tried to increase unemployment benefits. We tried to extend them. We tried to do trade adjustment assistance. All these things were so expensive and we couldn't do it. And I'm not saying just we, everybody. But, Congress after Congress found it hard to address this, this group that became increasingly disenfranchised and increasingly unhappy. And I don't think anybody blames them. And that is, I think both sides would like to capture that group and, to find those people who have been so disenfranchised and try to help bring them back into the economy. That's really difficult, though, and I think there's different opinions about how to get to that group and help. I mean, the election was surely a cry from that group, I believe.
Yeah, it's a great observation. I think one of the problems is, I agree both sides want to reach that group. Tax is probably not the right policy instrument. So even if you're successful in boosting the economy and creating some jobs with tax reform, which, as we're indicating, is a tough task, where are those new jobs going to be? And there's increasing amounts of evidence that, geography really matters, and most of the new jobs that are being created in the last 20 years have been in the areas that are already doing relatively well, areas like San Diego and Salt Lake City and Denver and areas, every reason to think that we're going to see more of those jobs, but that we're not going to suddenly see a manufacturing boom in Ohio. So I think if you really want to reach that constituency, I'm not sure tax policy is going to do it for you.
We had a question right here.
Yeah, Dick Shaw, Hicks, Fleischer, and Mack, a private practice lawyer. First a comment and then a question on the estate tax repeal. If I recall, many years ago, Treasury, in fact, proposed that it be removed. And we're dealing primarily, I think, with a public issue here, because the dollar figures are not large. And it would be my guess, I think, as Vic said, that rather than a complete repeal, it would be raised to a level where it will catch the big giants. My real important question goes to the issue of the corporate rate. And looking at it perhaps economically, I am concerned with lowering it to only 25% is going to be enough to assure that businesses will tend to keep their business in the States rather than going overseas. I'm impressed that they're suggesting a reduced tax for repatriation. I'd like your comments on the 25% versus perhaps 20. I think people who are talking as low as 15 are probably talking off their hats. But I'd like your comments as to, in your judgment and experience, economically, whether this 25% will work.
Yeah, my money's on between 20 and 25. My money is on lower because of what you say. I mean, the OECD average is already such that, by at 25, we won't really be getting to where we want. But it's hard to afford.
It's hard to pay for.
And at the very last minute, as Vic knows, when you're late, 3 a.m., the morning before you put out that paper, you get the score back from the Joint Committee, and you're like, shoot, we are X billion dollars short. And then you start fine-tuning the dials. And that's when I think the rate on the repatriation, the deemed repatriation, will kind of be fine-tuned. I think you'll hear ranges tomorrow maybe, and maybe even rates, but I go to the
It's
bank.
just an opening bid.
Yeah.
I'm surprised that it comes into play because I would have expected a larger reduction to begin with and then the counterpoint being to keep it up at 25.
But 15 is so low. It is impossible to put it. I think it's impossible. They have to be credible tomorrow. I mean, there's some fine line between being being credible and being appealing.
We had, I'm sorry.
Oh, so
We had a question in the red shirt back there.
I'm TJ. I'm a grad student in Cathy. And my question is, you're talking about how basically there's going to be this negotiation between the big six and the people. If our economy continues to perform the same way it has been, will it provide leverage to either side? And if so, how?
that's a good question. Next.
Well, the time frame's sort of short. Does this complicate matters or your question? The time frame is sort of short. There's not much time to build leverage. Maybe 6 months. So there's, I guess the short-term performance of the economy might matter, but I wonder if we really have enough time for the economics the larger economic context to change.
Are you saying that the economy is doing kind of well now,
Right.
and according to many metrics, and how does that impact it? And I think, when we look at paper, I remember the one thing they used to tell us when we used to sit with Harry Reid and the leadership and all the pollsters, that every time we talked about economic recovery, the polls went down. Like whatever they do to people, they sit in a chair and they. And because I think when we say the economy is doing great, like maybe here it is, it's a beautiful city, by the way, but it's not. I think a lot of the people that we're trying to speak to, the economy is not doing great, and they wonder what the heck are people talking about. So I think that everybody's getting different signals. Personally, I think this is going to be run by a bunch of, top-level policymakers and the politics of states and districts kind of individually.
Well, and the politics of parties, too, because a lot of those people who are going to be unhappy with corporate tax cuts are Democrats already. and so for a lot of Republicans, I think they aren't looking at losing a lot of their votes. I do think this is like a base versus non-base issue for them. Although, even among Republicans, you don't see support for tax cuts or tax reform at these super high levels. It's just not the most salient issue for most voters based on polls right now. But I do think, for the Republicans at least, I don't know that they're all that worried that people don't care.
I don't think I think you're right. But there's also a couple Republican parties, it seems to me, in some of the chambers. Like the Senate is a pretty uniform body because they represent they represent states, and there's all different kind of people in states. But the House represent generally pretty rarefied districts. So it's a bit, Paul Ryan must have the toughest job in the world. That's
No question.
hard to get all those factions together. So,
Out in the back, over there? Yep.
Alex, question I wanted to follow up on about the repatriation reduction rate. What is that going to look like? Is it going to be a holiday or a permanent issue? And what have we done in the past? Has it worked? What is the policy driving what we're going to do now?
Yeah, well, the last part of that, has it worked in the past, is the no. So to back up, what the idea here is, I think we will see a one-time tax on unrepatriated earnings, and then you can bring your offshore earnings back for free in the future. So this would be part of a permanent shift to a territorial tax system. The interesting thing is, because it's a tax on old earnings, there's no particular reason to keep the rate low, because you can't change past behavior. You could actually tax these old earnings at 35% at the sticker price, because that's, in theory, what Apple should have been paying all along. Cathy's, that's not going to happen.
channeling my inner Republican.
So that's never going to happen. You're going to see a lower rate. In 2004, it was a one-time holiday, and there are lots of problems associated with that. One is, most of the money was not used to expand domestic investment. It was used for stock buybacks. I don't think that's necessarily a bad result, but it's not going to boost the economy in a particular way. And we talk about it as a trapped cash problem, In fact, most of the cash is already here, so you can keep it offshore for accounting purposes if you reinvest it in foreign investments, or you can park it in a bunch of U.S. corporate bonds or put it by treasuries, and which means that the cash is actually already here, so you're not going to get a big economic push. So really, it's just about wringing a little bit of revenue out of the system. People generally agree that maybe the multinationals have been getting away with a little bit too much. There aren't too many folks, I think, who would tax it at 35%, but you'll see a rate somewhere in the middle. It kind of baffles me that it's quite as low as what I've been hearing.
Second to last row, and I think somebody here had a question still, or not? Okay, and then you, but in the back row first.
Charles Hurd, Rio here, University of Law. Just to follow up on the repatriation, could you see that the government forces their hand and require corporations to utilize the proceeds that are being brought back in a specific manner? And how so could they tote the line between government and capitalism?
We tried that. That was actually the deal in 2004 and 5 when we had an elective, and it didn't work.
Money's fungible, and money's fungible. So you just say, okay, I'm going to say that these dollars were invested in this new factory, and those other dollars are going to the shareholders. So it's more appealing in concept than it is in practice. It's very hard to draft an effective provision. And as you note, it gets the government in the business of deciding where new investments should go. And that's generally not a good idea.
Right here.
I think I probably have the last question, yeah?
Probably. Close to it.
Make it a good one.
You guys have I'm Jordan Berry, I'm a professor here at USD. I think I've met Vic before. So here's a moment for you guys as we're closing out. I'd love to hear what your thoughts are in terms of, assume there's a bill, what do you think would be the best thing in it from your perspective and the worst thing in it?
That's a good question.
That's something fun to end.
God, it's
I mean, I'll take the low-hanging fruit. I do think reducing the corporate rate from 35% to something lower is good policy, and I think there's broad consensus about that. I think the worst thing about the bill will be, I can't choose just one. The special rate on pass-throughs is terrible policy. We like, politically people like to equate pass-throughs with small business, but in fact, most of the money there is in investment funds and other very large partnerships, and it seems an odd time after the boom that we've seen in private equity and related industries. Seems like an odd time to reward them with a big tax cut.
There has been some suggestion that not all pass-throughs will qualify, right? The Treasury Secretary, I think, said service firms will not qualify.
Yes, that's the other reason it's bad tax policy, is it's not so easy to distinguish between service firms and non-service firms. And people have been using S-corps to circumvent a couple of percentage points of payroll tax for a long time, and it's not something the IRS has been able to figure out how to fix that problem. Now that we'll have 10 to 15 points difference, you're going to see an awful lot of gamesmanship. There is a silver lining. It's full employment for tax lawyers if it passes. So that's very good for my students and for the USD tax program.
Well, then I have to support that. But I think, I'm with Vic. I think a lowering of the corporate rate will be the best part of this bill. It absolutely, I think it's an essential need in this economy. It's an essential need in our markets, and to compete in global markets, we have to do it. And we just have to kind of connect the benefits of that to kind of people, to workers, to markets, to consumers, to jobs. And I'll tell you the truth is that corporate America has not done a very good job about taking their story to people, and it's always been very difficult to do with data, even though we always have a gut that it's right. But I do think that's the one part that's driving this whole thing, and I think it'd be really good to get that over with.
All right.
Yeah,
She was trying to duck that, I
Never mind. Right
think. Saved by the bell.
All right, well, that's it. I think we are out of time. Thanks very much for our panelists.
Thanks for coming, everybody.
I'm sure there's still one.